Hi, good evening, everyone, to the ASK Investment Managers Knowledge Series. We'll wait for a couple of minutes for all the participants to join in.
Recording in progress.
So we're going to start the webinar right now. A warm welcome to all of you to ASK Investment Managers Knowledge Series. My name is Gaurav Chakravarti, and I will be moderating the call today. As you all know, India has remained among the fastest growing major economies of the world, contributing to more than 12% to the global growth on average during the last 5 years. Despite the recent turbulent global economic situation, India has experienced strong macroeconomic conditions and financial stability with a steady pickup in the momentum of growth. And that forms the part of our discussion for this evening. And today we have Sandip Bansal, Senior Portfolio Manager, ASK, to assess the condition prevailing in the global and domestic market and highlights of our ASK growth portfolio. Sandip comes with a 2 decade of work ex with more than 15 plus years in equity markets. He has been instrumental in managing our growth portfolio since the time he has joined us from SBI Life, where he was the head of investment research, leading across asset classes. He comes with a strong educational background. Sandip is a chartered accountant, company secretary, and an MBA from IIM Ahmedabad. Today, we have scheduled an 1 hour for this webinar, where I would request Sandip to cover broader trends of the markets and the growth drivers for Indian economy, followed by a deeper understanding of the ASK growth strategy, insight on what happened in this calendar year so far, where we stand now, and how we see things going forward. This will be followed by Q&A, so I request all the participants to type in your questions and queries, and we shall curate and try them answered. All over to you, Sandeep.
Thank you so much, Gaurav. Thank you so much, everyone, for taking out your precious time for this webinar. We truly appreciate it. Gaurav, I will be sharing my screen, and hopefully it is visible. So please do let me know.
Yeah, it's visible.
Okay. Yeah. So just launching straight away into the presentation, there are 3 aspects that we would like to cover today. On the market outlook. First and foremost is the fact that there has been a improvement in recent times in our performance of the portfolio, and that is primarily attributable to 3 factors which we'll cover in the presentation. 2 are macro factors, one is a micro factor. The macro factor, the first one is the decline in inflation globally. So if you look at this dark blue line, this is global inflation. Global inflation, as it seems from this chart, has clearly peaked. The gray line is the US Fed funds rate. We have seen the sharpest increase in US Fed funds rate in recent times, wherein The rate has been increased by over 500 basis points in a matter of 14 months. There is a likelihood or a possibility, I must say, of another hike of 25 basis points at most, if that happens in the month of June. But that is likely to be the last hike of this cycle. What this clearly shows is that global inflation and global interest rates have peaked. This is a very important driver of valuations for global equities, and especially for growth stocks. As we know that the kind of investment philosophy that we at ASK have, we invest in the bucket of high quality and high growth stocks. The peaking of inflation and hence of interest rates is good news for the markets in general. The situation that has panned out globally has panned out in India as well. In India, the RBI has taken a pause on interest rate hikes. As we can see this blue line, the dark blue line, the RBI has now paused at a repo rate of 6.5%. The RBI has said that it will look at incremental incoming data to take further rate action decisions. CPI, has fallen from 7% kind of levels to currently more like the last reading was more at sub 5% or 4.7% kind of a level. We've seen recently that WPI has actually turned deflationary, and the reading is a negative of -0.9%. It seems to us that inflation in India also maybe the worst is possibly behind us, and it seems that rates are likely to peak globally, and in India also interest rate hikes are largely behind us. Why has this happened? If we look at it, key drivers of inflation, what were they in the past and how have they behaved in recent times? Which leads us to believe that inflation has likely peaked out. Commodity prices have corrected. So if you look at in the last 1 year and also from their peak levels, commodity prices are down by anywhere between 15 to 50%. And this is across the basket of hard as well as soft commodities. The other key aspect for us in India especially is oil prices. If you look at oil prices, they are down by 40% plus over the course of the last 1 year or so. India is a commodity hungry country. It is an energy hungry country. We need to build out an entire nation. And for us, this remains a key import item as well. We import 80% of our 80% plus of our oil requirements. So energy inflation was hurting us badly. And now this is now actually a tailwind in some sense. We also need to keep in mind the fact that in addition to this correction in oil prices, because we are sourcing a good proportion of our oil requirements from Russia, on which we are getting a good discount of 20-25%, that is also an additional benefit to us that is coming through. In addition to this, gas prices have also recently cooled off. Gas prices were more stubborn, but now they've also fallen the trajectory of oil prices in coming down. For India, the sweet spot of oil is, let's say, between 60 to 80. Above 80, it tends to become a bit worrisome for us. But currently, our oil import basket is at a lower price level. Not only with this crude level of around 70 to 75, along with it, we need to add the discounts that we get from on Russian crude. The third big driver of inflation in the last few years had been supply chain issues and freight rates. So, if you look at this freight rate chart, during COVID times, it had shot up considerably, multiple times of what it used to be pre-COVID. Now, if you look at it, freight rates have collapsed by 80 to 90%, and the current levels are more akin to pre-COVID levels. So we can safely say that at least on the freight rate side, we've come back to pre-pandemic levels. And with the reopening of China, supply chain issues which were impacting many sectors are also now much more in control. So the inflationary pressures that had built up in the global economy as well as the Indian economy because of these factors have now started to fade. The fourth impact was due to increasing agri prices. Agri prices are also down, though they are not corrected as much as we've seen some of the metal and the energy prices correct, but at least from the peak levels there is a respite on this count as well. So net, if you look at all the drivers of inflation, they are now have corrected and are now much more manageable and palatable versus earlier times. And hence, the interest rate cycle has also is close to peak levels globally as well as in India. The next big macro factor, is flows, FII flows. So, if you look at this table, what had happened earlier was that FIIs, through the course of the last 1 to 1.5 years, were largely in a sell India kind of a mode. There were obviously a few months when there were positive inflows, but there was largely a drawdown which they were doing from Indian markets. But if you look at the last 3 months, FII flows have come back. In fact, in this financial year to date, FIIs have invested more than $6 billion into Indian equities. The FIIs also generally prefer to invest only in relatively the higher quality basket within the Indian equity market. That has also kind of aided the performance that we've got in recent times. On the domestic flows, they continue to be strong. So these are SIP flows, monthly SIP flows. SIP flows generally tend to be more sticky. So if we look at, from April 21 levels, which were more like 8,500 crores, currently the SIP flows are more like 14,000 crores. If we take a yearly average, the average of FY22 was more like 10,500 crores per month. And the average for FY23 was more like 12,500 crores per month. In addition to this, we also get sticky inflows from NPS, pension funds and provident funds, and also there is insurance money. So there is a very good support that domestic investors are providing to domestic capital markets. A good part of that money is sticky, which is helping the buoyancy in the markets. The third point, which has led to a good performance in recent times, and which is actually the most important point of all, is the micro, which is good earnings delivery. So if we look at this recently concluded earnings season, the Q4 FY23 earnings season, the earnings have been for the market overall been better than expectations. The beats to miss ratio, or the number of companies that surprised on the positive side versus the number of companies that surprised on the negative side, was in favor of the companies that surprised positively. If we look at our ASK growth strategy, the earnings delivery was much better than the overall market. And this is our expectation going forward as well. If you look at it, the earnings expectation for the growth portfolio continues to be in excess of 20%, which is much higher than the overall underlying market. This tells us that the underlying economy is doing fine. For the next couple of quarters, we believe that the correction in commodity prices is going to aid margins, and the margin delivery is going to aid earnings growth, at least for the next couple of quarters. If we look at the overall market, which is, let's say, depicted by Nifty, we are expecting a mid-teen kind of an earnings growth. Let's say a 15% CAGR in earnings over FY23 to FY25. The overall FY23 earnings have been in line, and the next couple of years should see about a 15% kind of an earnings growth. If we now talk about valuations of the overall market, so this is a chart of the price to earnings ratio, which typically is looked at for a top-down view on valuations. The red line is this PE ratio. The black line is the median. So if you look at the median valuation of the market over the last 23 years or so, it was, let's say, at a 15x kind of a level. Currently, the levels that we are trading at is, closer to, let's say, around 19x or so. When we say that markets are cheap, those are these kind of levels when we are below the average. So in some sense, the markets are not cheap. But what has happened over the last 2 decades is that the composition of the index itself has changed. The composition of lower valued companies, let's say, some of the metals or the oil and gas names, or some of the public sector entities, which generally command a lower valuation, those have come out. And the proportion of companies which are, more in the sectors of consumption, that basket has gone up. Or let's say some of the relatively more richly valued but faster growing NBFCs, etc., their proportion in the overall index has gone up. So, maybe the last 20-year average is not the best metric to look at. If we adjust for that, we can say that markets are above fair valuation levels, but they are going to be supported by the earnings momentum going forward. If we talk about, our portfolio and its performance in recent times, so, obviously 2022 was impacted for us. But if we look at recent performance, last 2 months in this financial year have been good, driven by the 3 key factors that we recently spoke about. And we believe that the earnings performance of the portfolio is going to sustain the outperformance that we are going to see. So what is the earnings growth that we are expecting, and how does the portfolio stack up in terms of fundamental matrices? So if you look at EPS growth, we are expecting a 25% kind of an earnings growth in FY24 and 20% plus in FY25. So let's say over the next couple of years, we are expecting an earnings growth in excess of 20%. The market earnings growth is likely to be in the range of 14 to 15%. So the portfolio earnings growth is likely to be around 50% higher than that of the overall market. If we look at the quality matrix of the portfolio, the return on capital employed of the portfolio is likely to be in the range of 34 to 35%, which is significantly better than that of the market. If we look at the leverage position of the underlying portfolio, it is close to 0 in FY24, and due to the large free cash generation that portfolio companies are going to do, it is going to turn about 0 in FY25. When we talk about PE multiples, the price to earnings multiples of the portfolio are obviously higher than that of the market. As we saw, the 1-year forward multiples for the market are in the region of around 19 or so. For that of the portfolio is 50% higher. But we believe that given the strong earnings growth of the portfolio, given the quality of the earnings are better in terms of predictability, certainty, sustainability, the valuation multiples for the portfolio are going to remain elevated. So if you look at this 29 kind of a multiple in FY24, it actually just goes down to around 24-25 levels in FY25 because of the strong earnings growth. So, the portfolio continues to comprise of high quality, high growth, top-notch businesses in the country. If we look at the PE ratio of the portfolio, and over here we've shown the PE ratio of the overall portfolio on a trailing basis. So if you look at on a trailing basis, the portfolio is actually below its peak levels. So this is the average for the last 10 years or so, and the portfolio PE ratio is currently below the average. So in some sense, the portfolio is attractively valued, and we do expect growth in the earnings as well as a re-rating of portfolio companies. It is not that we are forecasting in terms of earnings a very high growth. If we look at portfolio companies in the past as well, they have achieved earnings levels which are better than the overall market. So if you look at the last 5-year CAGR in portfolio companies, it has been around 18%, while the market overall had delivered an earnings growth of around 11%. Our projections going forward are also around 50% higher than that of the market, but the achievement in the past has also been similar. In terms of overall portfolio positioning, around 30% of the portfolio continues to be levered to the domestic Indian consumer. Around 30% of the portfolio comprises of the banking and insurance space. But here again, the tilt is more towards lending entities that are more catering to the retail Indian consumer. Around 10% of the portfolio is levered to the infrastructure story in the country, where we are seeing very strong growth driven by the government. The government is expanding infrastructure in a big fashion. We saw in the recent budget as well that the capital allocation towards infrastructure had been increased significantly. And going forward, we think that this proportion could actually increase for us in the portfolio. Around 10% plus of the portfolio comprises of chemical businesses, which have strong tailwinds due to global diversification of supply chains and strategies of MNCs like China Plus One and Euro Plus One. Around 5% of the portfolio comprises of telecom business, which is a very good play on the increasing digitization in the country. So if we look at it, around 65% of the portfolio in some sense is very strongly levered to a domestic retail consumer in India, and hence is a very granular. Around 10% is levered to a very strong growth story of infrastructure in the country, and around 10% is levered to domestic manufacturing and exports led by global diversification of supply chains. So in some sense, while there are global macro risks in the world economy, this portfolio is relatively insulated from that. Obviously, there could be second or third derivative order impacts, but given the large leverage to the domestic Indian consumer and sectors with strong tailwinds, the portfolio is relatively insulated from global macro risks. The portfolio, because we believe in long-term holding, remains relatively unchanged. From the last call, we've not made too many changes to the portfolio, and the philosophy continues to be to invest in high growth, high quality businesses. So thank you so much for your time. This was it from my side in terms of the thoughts that I wanted to share, and Gaurav would be more than happy to take any questions here. Thanks a lot.
Thank you so much, Sandip, for giving a detailed brief on the portfolio and the macro and micro situation both. I request all the participants to type in your questions from the chat box. We shall try to curate all of them. In the meantime, there are certain questions have been, sent in advance to us. I'll try to take those questions and request you to answer them on a chronological order. So the first question comes in, like in the recent times, we have seen a sharp uptick in our performance, which you have addressed in the call as well. So if you could highlight the top contributor, which has actually resulted in this, performance uptick.
Right. So, in terms of sectors, it was both BFSI as well as consumption that contributed. As we stated that, we invest in the high growth, high quality basket. That basket had been impaired in terms of stock prices and in terms of performance. 2 months prior, let's say, for the last many months, that basket was impaired due to rising interest rates, FII outflows, and money moving from that basket to the overall market in general. A lot of the names that were going up are the names that we generally do not invest in because they do not fulfill our criteria of either quality or sustainable growth, etc. Some of these names, when the earnings delivery came through and there was a good de-rating in them because of price fall, as well as the fact that earnings delivery came through, and also the fact that there was time lapse as well. 6 to 9 months had gone by, so a lot of these stocks came back. If I just had to take a few names that came back strongly. So Bajaj Finance did well for us. AU Small Finance Bank did well for us. Varun Beverages did well in the portfolio. So, these are some of the names that did well.
Thanks, Sandip. I get another question from the chat box. Does your investment strategy include or allow taking future options position to either leverage or hedge portfolio positions?
Okay. The mandate of this portfolio is to invest only in listed equities. So we do not take any derivative positions at all. In fact, across all of ASK's portfolios, we do not take any derivative positions either to benefit from them or to hedge our positions. We just purely investing direct listed equities without any futures options.
Thanks, Sandip. The next question comes in like, will the ambit of PLI benefit going to enhance from here on, and the expected sector to be the beneficiary of it?
Right. No, that's a good question. So, the intent of PLI overall is to spur and incentivize the manufacturing ecosystem within the country. Manufacturing contributes around 15% of our GDP. The government wants to take it up to 25% of GDP. Wherever we've seen a low-income country move to a mid-income kind of levels, manufacturing has been one of the key sectors which has driven that transition. In India, this was something which was lacking because we are unfortunately burdened by a lot of things, including poor infrastructure, high power costs, outdated labor laws, etc., etc. So there was the requirement of an external push or incentivization, which the government did through the PLI scheme. So the PLI scheme is there across a range of sectors, ranging from automobiles, white goods, chemicals, solar power, textile. So there is a very wide range of sectors. Yes, we do expect PLI to come through in a lot of the announced sectors. It is still due, so it will come through, and we do expect that over the next many years, it is going to spur a lot of investments in the manufacturing sector, which is going to benefit the overall economy and a lot of allied and associated sectors to the manufacturing space.
Great. The next question comes in, why FDI investment in India is multi-month low, and few participant wants to ask about the US debt ceiling problem, which is hovering in the news on the recent times. If you want to give some inputs on that.
Sure. So the good news is that the US debt ceiling issue seems to have been resolved. The Republicans and the Democrats have come to a deal over there. So the debt ceiling is unlikely to be a challenge. We've seen that such issues have come. The debt ceiling issue has come previously as well, and it has been resolved. On that count, at least we seem to be fine as of now. Obviously, there are finer details of the deals that need to be worked out. But given that an overarching kind of an agreement has been reached, and given that the consequences of not having a deal or not implementing it far outweigh the benefits that could possibly be scored, I think it will be done. In terms of FDI, while currently it does seem to be lower than what we've been able to achieve, we'll have to look at it more from a structural standpoint. If we look at it globally, India is in a very sweet spot in terms of the fact that many parts of the globe are either having geopolitical issues or they are going through trust issues. Secondly, India is undertaking a massive policy and a reform exercise, which is incentivizing a lot of development in a lot of areas, be it manufacturing, infrastructure, renewables, etc. And from a large economy standpoint, there are not too many countries in the world, which can absorb large pools of capital. So we would like to believe that India structurally will continue to attract large doses of FDI. Could there be, interim volatility of phases wherein FDI numbers do not look that good? Yes, that is possible. But structurally, India would receive a lot of FDI. Historically, we've not received that much of FDI if we exclude the last few years. And our FDI to GDP ratios actually do not compare well at all globally. They are in fact very low compared to many of the countries which are far smaller than us as well. So, structurally, we will continue to see a good degree of pickup on this count.
Thanks, Sandip. We all know that we are market cap agnostic, but still there's a question that what would be the mix between large, mid, and small cap for you? I guess this is specific to the growth portfolio, if you could address. And also a joint question that do you think export will affect the export business, will get affected business on account of any resolution in the China-US trade war?
Sure. See, on the first question, market cap for us is an outcome. We are very strong bottoms-up investors. We look at the cash flows, their growth and robustness at the time of investing. And if we get that right, and businesses continue to grow, it does not matter to us whether it is a small cap, mid cap, or large cap. So that is the approach that we have in this portfolio. Having said that, from a classification perspective, let's say around 55 to 60% of the portfolio is large cap. Around 40% or so of the portfolio is a mid cap. We do not have any small cap stocks in the portfolio, any significant positions. Going forward as well, we are going to remain market cap agnostic in our investing style. These proportions might change quite significantly. We are only going to focus on the cash flows and the earnings growth and the robustness going forward as well. So, I would suggest not to focus too much attention on this aspect. The key matrix, if we look at, is more the earnings growth of the portfolio, which is 20 to 25%, more the return on capital of the underlying businesses, which is like 30 to 35%. So these two aspects, demonstrate the growth and quality of the underlying businesses. As far as the US and China trade deal is concerned, the way to think about this is that there has been a jolt that the entire world has faced in some sense over the last couple of years in their supply chains, because of the large dependence that the world in whole has on China. So China is called the factory of the world. It is said that in some sense around 25% of whatever is produced globally has some input coming from China. We believe that the diversification of manufacturing and the diversification of supply chains is a risk mitigation measure. That will happen nevertheless, even if there is a trade deal between the US and China, because there is over dependence on China. I think everyone recognizes that their level of dependence needs to come down. And given the low base of manufacturing that we currently are at, even a small shift from China to India leads to a big growth for us.
Thanks, Sandip. Now let me club again a couple of questions together for you. In respect to the performance, last calendar year has been a bit tricky for us, and there are certainly some detractors, and also the new names which have added in the recent past, and what to expect going ahead from them. This comes in the context that that we exited out of Dixon, and there is some positive thing happening to Dixon. So over to you.
Sure. No, that's a very fair question to ask, Gaurav. So, we've not made too many changes to the portfolio. We would generally like to hold stocks for a relatively longer period of time and not make too many substantial changes to the portfolio. That does not mean that we do not make a change when required to. Whenever there is a requirement, whenever we see a better opportunity, we'll definitely do that. Unfortunately, in Dixon, we had hit our risk trigger levels, and hence we had to, get out of that position. Every portfolio management business has certain risk triggers, which need to be adhered to from a risk management perspective. And so because of which, Dixon, the position had to be exited. We've added State Bank of India to the portfolio. The business mix of the bank is changing very favorably as growth is coming strongly on the retail side of the business. As we all know, State Bank of India had been focusing more on the corporate side earlier. Now they are growing their retail business very strongly. They are actually onboarding a lot of customers through their digital channel, their YONO app. They have a very good ecosystem of insurance, asset management, cards, and other businesses, other subsidiaries through which they are able to provide holistic solutions. And there's a lot of cross-selling opportunities that are being leveraged. The earnings growth profile of the bank is very good. The asset quality issues are behind us, and we do continue to expect good growth as well as good returns on equity. So that is why we recently added that to the portfolio. So since the last call of the last quarter, that is largely the change that we've made in the portfolio.
Thanks. Now, sector-specific questions. Our views on IT sector. And Infi is the name which we have right now. So what's the view on the sector and Infi in specific, if you can?
Sure. So, IT as a sector, we've always really liked because it is right up there in terms of quality. It is in some sense a benchmark in terms of high quality businesses in the country, great management, no debt, great returns on capital, great free cash flow generation. Unfortunately, it does not tick our box as far as high growth is concerned, because it is a relatively mature sector, and growth is more sedate than what we would expect. In the growth portfolio, we typically do not buy businesses which give less than 15% earnings growth. If you look at the growth profile of the portfolio, currently it is more like 20 to 25%. So while IT scores are perhaps the best in terms of quality, in terms of growth, it falters. So while we are convinced on the overall digitization theme, and we believe that it's a structural opportunity, we've not managed to find too many names which will be able to sustain high levels of growth for a length of time. On Infosys, the results, etc., the guidance, etc., were not good, because of which we did see a considerable impact on the stock price. Infosys continues to be our only position in the IT space. We have around 3.5 to 4% of it in the portfolio. In the benchmark, IT sector as a whole could be more like 12 to 13%. We believe that digitization, IT sector opportunity is structural. We believe that Infosys is, one of the best positioned companies to leverage on it on a sustainable basis. While obviously this quarter was not good, on a long-term basis, we believe that earnings will come through, and it obviously satisfies all our criteria on quality. So we continue to hold Infosys, and we believe that the stock will do well. Our post correction, the valuations have also become quite attractive.
Okay, so when I talk about sector, the next question comes in a few stocks. I know portfolio. There is some questions on a couple of stocks majorly. If I talk about Avenue Supermarts, the question comes in rationale for staying invested, wherein there are other opportunities available in retail segment, and also addition of Ambuja Cement, the recent context of the market and the way forward.
Sure. So, on Avenue Supermart, so we are invested in other retail-oriented businesses. We are invested in Titan Industries, which is around, let's say, 4% plus of the portfolio. We are invested in Page Industries, which is again around 3.5% or so of the portfolio. Avenue Supermart for us is similar to a relatively lower position. Avenue Supermart has been impacted due to a couple of issues. Firstly, what has happened is that the non-grocery part of the business has still not reached to pre-COVID kind of levels. So growth over there has been quite disappointing. And that is a business which is relatively higher margin. We do believe that that part of the business is also going to come back over a period of time. We honestly speaking had not expected that it is going to remain impacted for such a long period, but the worst kind of seems to be behind us. Secondly, what we've seen is that there has been a very good pickup in terms of quick commerce businesses, especially in metros in recent times. A lot of these businesses are private equity funded businesses. While they are very growth oriented businesses, none of these businesses make money. With the cost of capital having risen, we really don't know how long the investors of these businesses are going to continue to fund their losses. So maybe growth at the margin for companies like Avenue Supermarts have been impacted by the proliferation of these businesses. So I think we'll have to wait and see how the impact kind of really pans out over a slightly longer period of time. Just a couple of more points on the positive side for Avenue Supermarts. Firstly, the potential opportunity remains humongous. They have, let's say, around 300 odd stores. Potentially overall in India, they could be 4 to 5x that number, even by management's own admission. And we would like to believe that this is a management which is very conservative. Secondly, retail as a sector is a very large opportunity, and this is a unique company which has managed to execute this business on a highly profitable basis, and this is a high growth company. So while there in the near term there are challenges, we continue to be long-term believers.
Thanks. And on Ambuja in specific?
Sorry, yeah. So Ambuja Cements, Ambuja Cements is, so there have been a lot of market-related concerns due to the ownership of the business, but let me just highlight a few fundamental aspects of the business. This is a business which is completely debt-free, so there is no debt. Actually, this is a business which has lots of cash. So Ambuja Cements at a consolidated level has 10,000 crores of cash. So there are no issues of debt at all. Secondly, this is a business which is levered to the Indian consumer. Ambuja Cements sells 75% of its cement through trade channels. Actually, that number is more like 80%. So it is individual consumers that are, buying its cement up to the level of 75 to 80%. Thirdly, even the cement that goes in infrastructure development is actually sold to contractors rather than being sold to government directly, right? There are contractors who kind of, buy cement from Ambuja to build bridges, etc. So, in that sense, it's not a direct to supply to government kind of a business. Fourthly, Ambuja and ACC are amongst the 3 top brands along with Ultratech in the cement business in India. They are very well known, very old, very reputed brands in the country. And lastly, Ambuja and ACC actually had lost a lot of market share over the last many years because they were not growing. Now, they have an ambition to actually more than double their capacity in the next 7 to 10 years. And so this is a business which generates very good returns on capital, is on a high growth path, and it's a net cash balance sheet, which is levered to the infrastructure and construction story in the country. Our position in the portfolio is around 1.5 to 1.8%.
So we are quite positive on Ambuja at this point of time.
Sure. Yes, and the valuations have also become attractive given the fall in the share price.
Correct. In the meantime, request all the participants to type in your questions on the chat box as we are nearing the end of the session. In the meantime, Sandip, let me ask you a question wherein a gentleman says, as a portfolio manager, what's your major challenges do you see which can negatively impact the Indian equity growth story in the next decade? We know all talk about the positive growth story. What do you see the challenges, and how do you plan for any such challenges to be taken care of?
No, that's a great question, Gaurav. Thanks for that. I think the greatest challenge would be that if we are actually not able to execute the growth plans that we have for this country. We've always said for time immemorial that India has a huge demographic dividend. That energy actually needs to be channelized properly in the right direction. Otherwise, it could become a problem. So, we need to find employment opportunities for a large youth population. And that does require a lot of infrastructure development, that does require a lot of manufacturing ecosystem to be in place, that does require a lot of policy work, that does require a lot of work in capital raising. So, all the building blocks need to fall in place for that. So, the biggest risk, the biggest domestic structural risk that I see is that if we actually do not grow as fast as our potential is, then this youth energy that we are so proud of as a young country could actually turn into a big issue for us.
Thanks. There's an interesting question on your views on the EV theme, your picks there, and is there a solution like green hydrogen can give a jolt to the EV sector as a whole?
Sure. So, EVs is a structural growth opportunity. There is no doubt that the sector is going to grow exponentially from here onwards. At least in metro cities, it is more than evident that at least in large housing societies or in large residential complexes, you see an increasing proportion of EV cars coming through. The charging infrastructure is also getting facilitated in many parts of the country. So EV as a theme globally has already picked up. China is the leader there, in terms of the proportion of cars. India as a country also, we will see the EV sector growing very well. It's especially been fastest on the two-wheeler side, three-wheeler side. Passenger vehicles it is also picking up. In terms of picks, currently we think that it is, while I'll not be able to discuss specific names, we own Sona Comstar in a few of our ASK portfolios. I would like to believe that auto ancillary companies are more favorably attuned to cater to this theme. As far as an OEM manufacturer is concerned, the larger part of their profits are still coming from the internal combustion engine businesses. EV is still not contributing a meaningful value. Obviously, it will not as well. But given that this is a very fast evolving sector, identifying winners over there is going to be relatively more difficult. So auto ancillaries, but over there are not too many names. Could be a better way to play this. Sorry, what was the third part of the question? I forgot, Gaurav.
I think the green hydrogen will give a competition to the EV sector.
Sure. So green hydrogen, as of now, the path that it is likely to take is that it is likely to support the industrial sectors first. A lot of safety, transportation related issues need to be sorted out before green hydrogen can be used widely in vehicles. But over a period of time, given that technology is evolving fast, one would not be surprised that it does pose a challenge. But that there's a journey to be made over here. There's a path that needs to be traveled, and we think that it is still some distance to go. And in the meantime, EVs are going to pick up.
Thanks, Sandip. We'll take two more questions. Now, everybody is trying to anticipate that 2014 and 2024, they want to correlate. And a common question being, is the central election, state election, the political scenario is going to give any jolt to the market in terms of the performance? Or we are going to see a repetition of the euphoria which happened 10 years back?
So, elections are obviously difficult to predict. Nobody can predict an outcome. Would this remain an event-focused year, or would the markets like to know more about the potential results? The answer is yes. We do have a number of large state elections also coming up during this year, and the markets would take cognizance of the results for sure. If depending on how these state election results are panning out, the markets could take some cues from them and try to anticipate what is going to happen in the central elections as well. And obviously, to that extent, if the state election results are towards the market's liking, the anticipation could result in some kind of a reaction from the markets in anticipation of the central elections in May. So yeah, that could happen, but obviously we are not psephologists, and it will be difficult to predict election outcomes.
Correct. Now a straightforward question to you, that how much growth or CAGR returns do you see in the next 5 years?
We cannot and we should not talk about returns in the future, because there are no guarantees, and any numbers or figures could change drastically in a matter of months. And the honest answer is we do not know. Having said that, I think the framework to think about it is that if you look at markets in general, markets tend to follow market returns tend to follow earnings growth. Historically, Nifty has given a return of around 13 to 14%, with earnings growth of around 12%, and a dividend yield of around 1.25 to 1.5% on top of that. So that has been the trend of the markets in general. One could take cues from that, and one could also take cues from the fact that whatever has been the performance, historical performance, etc. One could take some ideas from that, but obviously there are no guarantees. Just in terms of growth, a lot of the building blocks for the economy are in place. Structurally speaking, as a country, the medium to long-term growth outlook for the country remains very strong. A lot of the concerns are largely global macro-driven, which we cannot really anticipate. We could not have anticipated the Russia-Ukraine war and the fallout on commodity prices, energy prices because of that. That is just one example. So a lot of these things cannot be forecasted. And we need to play it as it comes, as they say. But we would definitely like to believe that the medium to long-term growth opportunity for the country is very solid.
Very great to hear that. And now, if I ask you that, there's a question on specific to a BFSI segment. Let me ask you that question. Is there a threat to the Bajaj twins in respect to Jio Finance? How that is shaping up at this point of time? Would you like to answer this?
Sure. Again, I would just give some idea of the way to think about this. Finance is, any business is difficult, finance more so. And it takes a lot of time to build a good, solid business. Bajaj Finance has reached the stage where it has after a lot of solid work on underwriting, on collections, on distribution, on fine-tuning its various product lines, and on data mining, on analytics, and it has a very large customer base. That is point number one. The second point is that finance and consumer finance has always been an extremely competitive space. When Bajaj Finance entered this space, it was definitely not, in most of the segments, it was not the first entrant. And, there were very large, incumbent, well-funded banks and other entities which were already there in that space. The third point is the opportunity size in itself. The household credit ratios or the indebtedness of the Indian household or the Indian consumer remains less than half of global levels. As a country overall also, if we are anticipating large growth, then the credit demand will also grow significantly. So the market in itself is quite large. The opportunity is humongous. And there is space always for more and more players because credit penetration could certainly go up. And it is not that competition for Bajaj Finance, for that matter, any other financial institution is going to be new. Obviously, whenever a very large, well-funded player with a very strong execution track record comes into the market, for concerns to arise are very fair. But that is what a good management, which also has a very strong execution track record, does. It kind of takes on competition head on and find newer and newer ways of growing. And the market itself grows, the market itself expands, and maybe all the good players kind of continue to grow well. So these are the aspects which we would like to keep in mind. while evaluating the Bajaj Finance story from here onwards.
Thank you, Sandeep, for your patience and addressing all the questions and deciphering the markets for us. Would like to have your closing comments.
So thank you so much, everyone, for your valuable time. We truly appreciate it. As we said that, we expect the medium to long-term story for the Indian economy and the Indian markets to remain strong, and we would like to, actively participate in the same. And the portfolio will continue to comprise of, high growth, high quality businesses that are levered to this story. So thank you so much.
Thank you so much, Sandeep, and thank you all the participants for attending today's call, and we shall be sharing a recording of the same. And this concludes today's call. Thank you, everyone.